Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look, see what people are sharing, and I'll share my opinions. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these sectors looking for potential investment opportunities. What I am doing is I am looking for max leverage. Max leverage means big upside potential, big asymmetry. And if you want to get the most out of your investments, I would take a look to see what I'm doing and how I'm doing it. That is definitely worthwhile, and I show you guys how I'm doing it. Mayday coupon code is still active if you'd like to join and try it out for the first month, 50% off, only that first month, and a yearly membership can be had with a discount with that coupon code. So momentum structural analysis, which is Michael Oliver. What he says, and I do agree with this, he says, and this is in response to this. We'll go up and do the response first. It says, BJ Milkshake is buying puts on gold again, this time with almost 400 simps liking his posts. March forward, Milkshake simps. Stochastics at 99, DSI in high 80s, maybe 90s real time. Largest commercial short position in history, and Twitter loaded with bulls. Not selling long-term strategic gold position, but buying puts as a short-term tactical trade. Good luck to all, is what he says. And he's referencing this relative strength indicator, or I don't know what the DSI is. Maybe that's some other strength indicator. And then the stochastics up here, up at 99, maybe higher. Michael Oliver obviously replied is RSI is where all the gravy is in any market. The most explosive moves occur almost exclusively in the overbought territory. Twitter is not the market. It's so silly to judge sentiment by a handful of gold bugs on this site. Also, he continues to misunderstand, misrepresent what commercial shorts are. Yes, there are bullion banks and also producers who are always short as a hedge. It's meaningless. So I would agree with Michael. When things get overpriced to some degree, it doesn't mean they can't go higher. In fact, I've seen relative strength indicator valuations. I don't even use the RSI anymore. I think it's a indicator that provides zero value. But yet, he is using that stochastics and relative strength indicator as a way to determine if you're buying and selling something. When a market bounces off its bottom and goes into a strong trend, it can stay in that RSI over 70 the entire time for many, many months and maybe even years, depending on how strong the stock is and where you're located in that market condition. I don't use MACD or RSI. I used to when I was a rookie investor. So when I was a rookie and I didn't know as much as I do today, and I'm not saying and comparing to the BJ Milkshake theory guy, but I when I found out that there's so much more valuable things to look at, I got rid of all of it. I got rid of MACD. I got rid of RSI. I don't really even use moving averages that much. Some people use moving averages like the 200-day or 50-day, and that bounces off of it. I used to when I was more of a rookie guy way back, but I dropped it all. I dropped it all, and then I looked at cycles. I focus more on cycles. I focus more on the overall big picture chart pattern. The chart pattern I focus on is that big bubble pattern with a double bottom in stage one and stage analysis. I focus more on that than I do the 50-day or 200-day. I think it just muddies the waters. The relative strength indicator, there's no reason to even look at it. And I agree with Michael here. With my experience and me I used to do swing trading. I used to be a trader. That's where I got a lot of my technical analysis background and roots from, was doing swing trading back in the day. And the RSI, you can just chuck that in the water there. It doesn't really give you anything. It's a lagging indicator. What I look for are leading indicators. Leading indicators are a lot harder to kind of piece together because it's not an indicator that you grab from a chart. It'd be indicators that you piece together from the overall market. It is indicators in conference calls that you can listen to, and you can listen to insiders and what they're seeing. And the leading indicator is when the market shifts and the insiders can see it in sales. They can see it in all sorts of stuff. And then once they see it, then the buying pressure generally shows up in the charts. It's good to have both of those indicators. You get the leading indicator of insiders and hearing it. You get to see the charts moving in sync with that. And then you can take action. You can also pair that with technical patterns, like bottoming patterns, like a double bottom or an inverse head and shoulders, or a squeezing of a wedge or a falling wedge or whatever the heck it is. It doesn't matter what it is. You want to see it all kind of tie together. You can even buy some of this stuff before the volume comes, because what you're doing is you're beating the guys that are insiders that are a little bit slow and may need to get approvals in their big trading fund to start buying a different new sector. So that could even occur. And that's being what I consider to be on the leading front edge, where you can get the best returns possible. And my engineering background and my root cause analysis that I've done through 20 years of doing this, finding root causes to solve problems in manufacturing, that's what led me to use the same approach in the markets. Use the same type of root cause analysis to get to where the root cause is. And really, the root cause is the market conditions changing. The market conditions changing and that yield curve and all those things put together. Coming down, we've got Dan Subuchi. How are you? So it's common sense. It says, if you're going to meet these power needs of what they need for AI, you're going to have to use natural gas. Also, can't retire a nuclear plant, won't get by PUCs. It can't. It's going to hurt the consumer too much. So I agree with this statement. I think in the short term, if you want to power AI, you're going to have to use natural gas. And you know what? I just so happen to have a bunch of investments in natural gas to take advantage of this. Really? Yeah, I'm playing this AI through the use of natural gas, and natural gas is incredibly cheap. Looking at the ratios, natural gas is a steal today. So I understand that people, they look at things and they say, oh, that's way down. Exactly. Exactly. It's cheap. That is when you want to buy. You want to buy when no one else wants it. Guys, all you want to be when you're an investor is you want to be a ninja. You want to be a ninja. You want to go in there. You want to buy some shares when no one's looking. If it's a lower liquidity area, you may have to put some limit orders in so you don't push the price too much depending on how much you're buying. But you want to be a ninja. You want to get in. No one's looking. Everyone's looking at some loud, shiny object that's flying higher. And then you go and you buy behind everybody when no one's looking. And then when the herd turns and says, wait a minute, this looks like it's going to bottom, and it starts to go off its bottom and starts ramping up substantially with short selling, short sellers covering and stuff, you're already in the stock. You're just laughing. You're like, oh, look, shiny object over here. Got it. Captured that bottom. So the Kobayashi letter says, breaking, super microcomputer stock, SMCI, has now been halted 3 times and is down 13%. This comes just minutes after the U.S. Justice Department announced a probe into the company. SMCI recently delayed their 10K filing for full year 2024. The company said additional time is needed to complete assessment of its internal controls over financial reporting. Concerning, to say the least. I'm sure somehow Nancy Pelosi probably got some sort of put option before this big move lower. I don't know if she did, but maybe she did. Because, Justice Department and insider floating around of them going to do that. Neither Saudi Arabia nor the wider OPEC Plus group have any specific practices. And no member of the Producers Alliance is about to abandon output discipline in favor of chasing market share. Multiple OPEC plus sources have told Argus. So that article, and I'll show you the article below, is probably just FUD. It is information that they throw out there to keep the oil price down. There was a time when we had the silver breakout, that silver squeeze back in the day. If you looked, they put articles out that day and the day after to try to hold the price of silver down, saying that it's a sell. Why would you go into it? Guys, these banks are ruthless, and probably the Federal Reserve is tied into it, and maybe even hedge funds, or maybe the Goldman Sachs and Merrill Lynch's of the world. These guys are going to throw out crap and try to manipulate the news to get you and other people to dissuade you from buying or selling certain stock at certain times. Talk about insider information, and then using news outlets to also influence the mass. A4 Alpha says TMF headline news may move stocks for a week. WEEK. Those who understand the near-term nature of headlines and valuations will hold firm. Economic data will soon firm. China is now stimulating. OPEC has time and is best to be patient here to assess data and compliance before acting. I agree, and he's talking about the oil markets here. He's talking about the oil markets, and a lot of people are going to panic just because the price is down. Don't be one of those people. Don't be a panicker where you're like, oh my God, it's going down. Guys, we're at a really cheap price. Oil's cheap to gold. It could get cheaper. So what? We're at a very cheap level. We're at the break-even cost of some of these higher cost producers. We're talking about the high cost producers. So I don't think supply is going to be reacting very much here. And if we continue to go down a little bit, I don't think supply is coming. And if this market isn't as weak as what most people think, well, there's your ability to take a different stance than the market. And we'll see if that plays out that way. We don't know. But usually when you buy something and you're buying it when everybody is afraid, that's generally a decent time to be looking, is what I'll say. Now, I don't know if in the short term this is going to turn around immediately. But we could still have a little bit more downside left for some months to go. We still could. But I see that all as a buying opportunity here over the next few months in oil and oil-related equities. Northstar says, Dow Jones breakdown versus gold, critical to your trading investing for the next 10 years. And again, guys, I cannot stress how big of a deal this is. The 1930s, you can see in the corner there. Let me move that over just a teeny bit for you guys. There we go. Okay, there. So in the 1930s, we came on up, and this is the Dow Jones outperforming gold. We turned, and then we came back down and broke the uptrend line. And this is a huge move in commodities and gold. Huge move. We had another outperformance of Dow Jones in the 40s, 50s, all the way up into the 60s. The 60s it peaked and turned back down, and we broke out in the early 1970s. Boom, huge move lower, all the way down. This year was an insane outperformance of gold and commodities. Then in 1982, 81, 82 is where the interest rates peaked. We bottomed in commodities. Dow Jones Industrial Average and S&P 500 bottomed. This was the best time to buy equities, not commodities, equities. And then we rode all the way up to 1999, 2000. There's your peak, and then another commodity bull market. So right now, we've broken out of the uptrend line, and we are going to outperform. Commodities and gold are going to outperform the Dow Jones and S&P 500. We're right at the beginning of it. We're right at the beginning of this move. Do you understand the weight of this? Like, this is all you got. If you were born, I was born in the 80s, okay? So let's say you were born somewhere over here. You can ride equities up. This is the best possible time to buy commodities. Write it down. Another best time to buy commodities is right now. Right now. And if you can choose some of these really good, highly leveraged companies that are high quality, oh my God, guys, you're going to get 10, 20, 30 times your money very, very quickly. Just like buying the stocks back in 2001. Huge, huge move. Gold's the leader. Gold's been breaking out. It's our leader, guys. So what he says is a huge gold bull era and stock market crash. It's likely to take many years to recover. Whilst it's recovering, precious metals are expected to massively outperform, is what he says there. I agree. Burns Co. says USA crude oil stocks getting interesting levels. Market continues getting whacked on random bearish narrative headlines thrown around, but something to watch as levels drop below the bands. We're below the 5-year cloud now on the weekly inventory. We've got Warren Pies. After the election, market share strategy returns. So Saudi Arabia is ready to abandon its unofficial price target of 100, blah, blah, blah. This is all fun. This is the article that came out that people are saying is not right. It's not real. I don't know if it's real. They just threw it out there, and they can do whatever they want. It's the news. Money wisdom. The world is split between those who don't know how to start making money and those who don't know when to stop, says Nassim Taleb. Split between those two. So which group are you in? Don't know when to stop making money or start making it? Cornerstone, he says, who comes up with this bull crap? The press has force-fed us the phony story for over 4 years. The FT doesn't know the first thing about OPEC policy. That's the FUD. They're trying to get you to sell. They're trying to hold the price of oil down to some degree, I think. I don't know what the motive is behind it, the motivation. Here's Warren Buffett. It says, don't look for the money. Look for something you love, and if you're good, the money will come. A price explosion boils down to this one chart. Lithium prices are at rock bottom. It's putting miners out of business, mid-tiers, cutting costs, and dissuading explorers from developing new projects. All at a time as demand continues to expand. For mega-scale, low-cost producers, low competition is amazing news. Thanks to the Inflation Reduction Act of 2022, North American lithium is set to command a stiff premium over global lithium. And adding fuel to the fire, the Canadian government just announced to slap major tariffs on Chinese lithium. This is all reaching a boiling point, and a large, high-grade Canadian lithium project has suddenly become far more valuable. Already, lithium appears to be forming a nice price bottom. It might not be the bottom, but anyone who thinks they can time one is full of it. Many lithium stocks are up 20-30% from their 52-week lows. Here's the historical lithium returns and the cycle going back and forth. And what he's got is a question mark going higher. If you guys are interested in finding what you think is a bottom or what you want to purchase as lithium stocks at a bottom, I've got a couple that I think are pretty good. I've got a handful that we can look at and chart out, and they are putting in bottoms. And if you guys want to look for those and know what those companies are, I'll share them this weekend. We can also do some other things with portfolios too, and I can go over what I think looks good at this time, because there's a lot of things that look like they're bottoming right now. Jay Hinster has the Sprott Physical Uranium Trust, a continuation of bull flag formation targeting $45, a 70% rally. Almost looks like a cup and handle here too. The cup and the handle, you can see the top here, and then the handle there. If we can break out of that, that could be a pretty big move on this cup and handle that is forming in the Sprott Physical Uranium Trust. Investment wisdom, Peter Lynch, the advice I would give to any investor. Let's read this real quick together. It says, an excerpt from a recent edition of the Investment Wisdom newsletter, The Saturday Shareholder. So here it is, Peter Lynch. The advice I would give to any investor, find your edge. Play to your strengths and, as importantly, turn your opponent's strengths into weaknesses. One way to do this in investing, large money managers have an Achilles heel. It's their size. So investing in a small company isn't going to materially impact their portfolio. Even Buffett can't overcome the laws of mathematics. Size did us in. There remains only a handful of companies in this country capable of truly moving the needle at Berkshire. So small companies are neglected by some of the most experienced investors, which may present opportunities for smaller investors, as Lynch explains. Big companies have small moves, small companies have big moves. Playing to our strengths give us the best chance to beat larger, more experienced investors. But best chance certainly doesn't mean perfect chance. Of course, we'll make a few mistakes along the way. So what's the best way to handle mistakes? Stay tuned. This Saturday's newsletter looks at Charlie Munger's model for overcoming failure and how to turn into one of your biggest strengths. So that is some of it. So what I do in my approach, if you guys are trying to copy my approach is looking for asymmetry, risk reward. I don't go too small in the small caps. I don't go too big. There's a sweet spot, in my opinion, where risk reward times probability is maximized. And it changes for a lot of the sectors, but there's a general rule of thumb. And I consider that to be some of these larger developers and some of these smaller to mid-cap producers. That's where your leverage is at. And that's also where the higher probability of success is. And you have to look for a couple of different things. It seems like whenever I stray away from that model, my probability declines or my returns decline whenever I stray away. So there's a couple of things I can do to find that sweet spot using technical analysis, using fundamentals, using a couple of different things is what I'll call it. I also look at the assets as well. Grady says, just like silver was, platinum is now sitting right below a historical, huge blue breakout line. A generational breakout and opportunity is incoming also for platinum. It has now been basing out for about 10 years, just like back before the start of the secular bull market, back in the 90s. And in 2020, it resumed its secular bull market after a 13-year-long cyclical bear market. The coming blue breakout will confirm the resumption of the secular bull market for also platinum. Also, the blue breakout will mark the start of wave 3, which is the strongest and most profitable move. As said 4.5 years now, do make use of what will be the greatest commodities bull market ever seen. So this is platinum ready to break here any second. You can see the bullish MACD. Again, I don't even use this anymore. You can just see when they squeeze up in the corner like this. That's when you get the breakouts. I'm fully locked and loaded in this thing. You could just call me Platinum Boy if you'd like. I also like silver. I'm Silver Boy as well. So I'm a silver platinum guy right now. I think they're absolutely phenomenal setups in both of them. I am very excited for it. And I think a generational opportunities here, and I'm taking full advantage of it. No one on Twitter, no one on YouTube can convince me otherwise. These charts are undeniable. The ratios are telling me it's game on, and I don't know if there's anybody that can convince me not to go into this. And I've already gone into it, but can convince me otherwise. Coming down, we've got Kevin Bambro. He says silver shorts are going to feel some real pain. Wondering who will be the amaranth of this cycle, and they see their firm and reputation destroyed. When silver spikes to $75 an ounce, someone major will see their solvency challenged. I agree, and I don't know what that means for these banks, guys. It's not just silver, though. It's across the board. You've got gold, platinum, silver, palladium, all being massively shorted by these big banks. And he's talking about the banks here. He says when silver spikes to 75, well, what if platinum spikes with it too? I mean, what's going to happen here? These guys are going to get squeezed, and I don't know what that even means. Are we going to get like some bank bailout that has to happen and occur? What does that mean for the stock market? And I've been looking at this for a long time, and I think it was, who was that? I can't remember his name, who put together the big banks and how short they are. I think he passed away recently, if I can remember. But he put that together. I saw that back years ago, and I was like, "Oh, this looks good." Then I saw Hubert Muhlman. I saw a logarithmic silver chart back in like 2017, and I saw that, and I was like, "Oh my God, this thing's going to be big." And I knew technical analysis, and I looked and zoomed out on silver and said, "Oh, this is a cup and handle, and I can buy it right at the bottom here." And I started buying very heavily silver in 2018. I went ballistic on it, yeah. And I'm still looking at this, and it's like, God, these patterns are huge. And when they break, the ramifications to some of these banks is going to be, I don't know. I don't think we've ever seen anything like that because they're all short trying to hold it down. But good luck. This is gonna spike like heck. Jesse Colombo says gold priced in Swiss francs, one of the final holdouts, has finally broken out. That is particularly momentous because Switzerland is a very important center for the gold industry with its numerous mints, refiners, and trading firms. There's the breakout against the Swiss franc. The dude says there was 600 million paper ounces traded yesterday to prevent silver from breaking 32.50. Get your popcorn ready once we close above 32.50. The silver squeeze is back on, boys. When we get above 32.50 and start closing above it, these guys are losing the game. And what's crazy is they've got infinite amount of paper at this thing. This is going to get real interesting if the physical gets a little bit short here. So now the chances of a second jumbo 0.5% rate cut in November have surged over 60%. Everything is fine. No worries. Christine says, just published my research on the Permian Basin and why I believe oil and gas is unlikely to grow further. Environmental issues around water handling can no longer be ignored. And she talks about the Permian's watershed moment and how she thinks it's unlikely to grow. Here's Kevin. So he says uranium stocks will be making new highs for this bull market in a few months. The great news just keeps rolling in. New builds, life extensions, and restarts. Demand exploding higher as supply struggles to increase. I'm debating getting nuclear power tattoos all over my body like Stroman. So that's what he's saying there for uranium. I would agree. Everybody's sentiment was dog crap here just recently, and it's gonna turn, and then we're gonna rock it in uranium, and everyone's gonna forget. And of course, what are those guys gonna do? They're going to chase the price of uranium higher. Investing is a battle against yourself, guys. It's a battle against yourself. I can teach you all this stuff. I can show you good entry points. I can do all those things. But it's a battle of you versus your emotions at that point. And most people can't handle it. It's as easy as doing nothing and doing nothing for the longest time. That's what I've learned. I learned last bull market. I tried trading in and out. I was inexperienced. I was new. And I made a lot of mistakes. But I learned from those mistakes. And the mistakes, there's like a couple of mistakes. I wasn't as good of a charter in the beginning of that last commodity bull market, so I was just learning. That was something I needed. I wasn't patient enough. Patience is everything. Patience, 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 patience. Everybody wants to get rich quick. I understand it, and sometimes you do. But patience is needed for those that are bottoming out, and you're trying to buy a bottom to come back up into cycle. So patience is something that a lot of people don't have, and they can't hold through drawdowns. Drawdowns kill people. So patience and drawdowns are the two things that people lack the most. So if you were to get good at anything, if you were to improve on something, patience and holding through drawdowns. It's essential if you want to play this game and play it with these big moves. So those are the two things that I think people are the weakest at. But that's what I've got for today. We'll end it there, and we'll catch you guys later. This is Finding Value.